Hello everyone and welcome to today's class on supply chain finance. This is a two-part lecture and we will be starting off with the basics today, and I will build on further with the second lecture on supply chain finance on the core concepts that we learned today. So without further ado, I'd like to sort of talk to you about some important financial statements that companies deal with. There are three key financial statements that every company deals with. The first one is cash flow statements, also known as statement of changes in financial position, income statements, and balance sheets. It's extremely important from a supply chain point of view to understand that every single supply chain related transaction has an impact on all three of these financial statements. Therefore, it's important for us to understand, number one, how each of these financial statements work, and also how they are impacted by supply chain management transactions. Just want to also mention quick facts over here. Annual reports is a document that is generated pretty much by every public and private company. And it really summarizes, it includes these three financial statements. And it also includes some additional information. Usually there's a note by the CEO or the chairman of the company. It includes more notes on the reason behind changes in the financial statements. And so that is also a very key financial statement that is generated by companies. And then there is the 10K, and the 10K is basically, it's specific to the US. It's a document that is filed annually by publicly traded companies. So just kind of wanted to give you a quick overview of that. But for the purpose of this class, I will primarily be focusing today's lecture on income statements and balance sheets. I'll sprinkle in a little bit of cash flows, but I'll be covering more of that in the next lecture. And let's move on. All right, so I'm going to start off with income statements, and I think a good way to really understand income statements is to really get an idea of the definition. And so income statements basically is the sum of income generating transactions over a stated period of time. Another word for income statements is also statement of operations. So let's really break down exactly what that means. Basically, an income statement captures anything related to transactions that have happened in a company that generated some sort of an income. Now, if you are generating income, usually there's also a cost or an expense related that is associated with generation of that revenue. So that's also called expenses in an income statement. And you'll also see profits in an income statement. So there are three big buckets in an income statement. The first one is revenues, usually sales, turnover, proceeds. These are all names, but that are affiliated with revenue, but it's basically the money that's coming in. Then is the second bucket is expenses. And this is basically has three big kind of categories: the cost of goods sold, operating expenses, and depreciation. And finally, you will see revenue minus expense, which will give you the profit. Now, the profit can be sliced and diced in several ways. You will see in income statements the gross profit, the net profit, the earning before income and interest and taxes. So again, this is basically, looking at the profit in different ways, but net, you are going to see these three buckets, three big buckets on any income statement. And one thing to point out is usually an income statement is for 1 year. So it captures all the transactions that have happened over a period of 1 year. So let me dive a little deeper in the second bucket, which was expenses. Expenses, as was mentioned in the previous slide, has a few categories within it. One of the key categories is cost of goods sold. This is also known as cost of sales. And this includes basically every direct cost attributable to the production of the product sold by the company. So whatever the key product is, any expense that is directly linked with generating or producing that product it falls under the cost of goods sold. And again, it's anything. So let's say, for example, there's a company that is producing light bulbs. Well, all the material of that was used to produce the light bulb is included in cost of goods sold. All of the wages of people that were working to manufacture the light bulbs falls under cost of goods sold. However, indirect costs, for example, the cost to advertise the light bulbs or the cost of the other people, in the factory that are working, do not fall under cost of goods sold. There is a separate bucket for that. And I'll just talk about that in the next slide. So again, in cost of goods sold, it's basically all the direct material and the direct labor cost used to produce the product. All of that comes under cost of goods sold. So in addition, so within, so what happens with all the other costs? What happens with the cost of advertising? Where does that go? What about the cost of all the other people in the factory that are doing, let's say maybe the security or the warehousing or more of the other sort of administrative roles? Where do their salaries fall in an income statement? Well, all of those costs fall under another category called sales, general, and administration. So SG&A. Now, just to break this up, this includes sales costs and all of the marketing and sales costs to really promote products falls under sales. And then general and administrative expenses. Now, these include all the wages of non-sales people and like the people that are not associated with necessarily directly producing the goods, and the people that are not, actually, marketing the products. All those extra or additional people in working for an organization, they come under the general expense category. Also, the cost of utilities, the rent expense, the insurance expense, all of those fall under the administrative expense. So you can see this is a pretty big category of expenses, and quite a few expenses fall under this category. Again, these are all these are not necessarily associated with directly producing the goods. So very important to be able to differentiate sales, general administration versus cost of goods sold. Some other operating expense elements or some other expenses that you will see on an income statement include depreciation. And so depreciation is basically how the reduction in the value of a tangible asset over a period of time. So for example, if you look at the prices of cars in the market, a brand new car was going to be priced high. A 1-year-old car is going to be priced the same car. A year older is going to be priced lower. 2 years later, 2 years old car is going to be priced even lower. So you can see that every year there is a decrease in the price of or the value of the car. That is a depreciation expense. Similarly for, let's say machinery, production machinery and all of that, that is also being depreciated over a period of time, and that is captured on the income statement. Some other things that are captured on the income statement include research and development. This is a very big cost for companies such as chemical companies, pharmaceutical companies, tech companies. All of these have very large R&D costs. There's also amortization. And so this is basically the depreciation or the reduction of value of an intangible asset such as goodwill. And so this is basically what goodwill is. is the premium paid above the book value for an asset attributable to the brand value, IP, or reputation. So, for example, if there is, a Louis Vuitton handbag, people are ready to pay an exorbitant amount for that, basically because of the brand value. Um, it's much more than the actual cost and the manufacturing and the actual cost of the product. So again, there is usually a reduction in the value of the brand over a period of time that is captured as an amortization expense, and that shows up on the income statement as well. So if we look at an income statement, this is an income statement on this slide of General Motors in 2014. We see some key data over here. We see the total revenue. So that is the incoming revenue. Then we see the cost of revenue, also known as the cost of goods sold. And if you take the total revenue minus the cost of goods sold, you see the gross profit, right? But then after the gross profit, there is also some other additional operating expenses. Here you can see in this slide, there is selling, general and administrative, SG&A costs. There are some non-recurring costs. And if you subtract that, that then gives you the operating income or loss. So again, this slide basically shows you how on an income statement you can see, a lot of the terms that I have discussed with you on the previous slides. Next, I will be talking to you about another very key statement, financial statement, that you do need to know very well, which is the balance sheet statement. And again, I'm going to start off talking about balance sheets by just really talking to you a little bit about what the definition is. So balance sheets are reports that show the financial condition of assets and liabilities of the business at one point in time. And so basically balance sheets many times are known almost like a snapshot, almost like you take a picture of what's happening in a company at one particular point in time. And it really captures, balance sheet capture, three basic, has basically three components. The first one is assets, and the second one is liabilities. So one thing to really mention on this slide is that there's a very simple equation within liabilities. This is a very, very broad category, but within liabilities, there is the actual liabilities and the shareholders value as well. So we'll be looking at that in more detail when I actually show you a balance sheet in a couple of minutes. So again, on a high level, if you look at a balance sheet, it will have assets that, this is anything that has a measurable value that is owned by a company. It does not always have to be a tangible good. It may be an intangible good as well. And then on the other side is the liabilities, and these are the claims against the assets. So these include, debt that has been, for example, incurred. So all of that. So on one side you see the assets, and on the other side you see the liabilities. Okay. One thing to note is that assets always have to equal liabilities on a balance sheet, and this is something pretty cool because it has a very interesting way of working out. I always find it so fascinating to see how income statements, balance sheet statements, and cash flow statements are linked. And within them also, there are so many interesting balancing equations, such as assets always have to equal liabilities on the balance sheet. One thing to mention here is that when an asset value is recorded, it is recorded on the book value, not on the market value. So the book value is basically the original value that the asset was bought at and you minus the depreciation. So that is the value that is sort of reflected in the balance sheet. It is not the market value of any good. There are various ways of valuing inventory, which is not something that is on the asset side of the balance sheet. There is LIFO method, FIFO method. I'll talk to you a little bit about these in a couple of slides ahead. Okay, so now let's look at a balance sheet statement over here. Okay. This is a balance sheet for Intel. It is dated to 2014. But if we look at it, there are two basic categories. There's all the liabilities at the bottom, and then there's the assets on the top. So let's look at the assets, right? Here you'll see that there are usually current assets, and then there's long-term assets. So the current assets include things that have high liquidity, easy for you to go in the market and sell. So it includes cash, short-term investments, trading assets, account receivable, inventories. These are the kind of things that are included in the total current assets. Things that are a little harder to liquidate include, these are the sort of the long-term fixed assets. They include the property, plant, equipment, long-term investments, goodwill, these kind of things. And when you add the sort of liquid assets and the more fixed assets, you get the total value of assets. And this amount has to equal, the total liabilities. So let's look at what falls under the liabilities section. There is the liabilities and stockholders' equity. So I think I call this shareholders' value, but better term is shareholders' equity. So let's look at how this section really, what the key, how this is broken out. So within liabilities, stockholders' equity, there is first the current liabilities. This is, short-term debt, really. For example, and I'm just going to sort of read out what the categories are within this, but again, this is for, and you basically have picked up short-term sort of debt to finance your company. So anything that you've picked up that's kind of short-term falls under this category, including short-term debt, accounts payable, accrued advertising, deferred income. So all of these are kind of in the current liabilities. And then there is the long-term debt. And this is the debt that you've taken, over, let's say, a 5-year loan, for example, or a 10-year loan that you've taken. So that's also in this category. And finally, the shareholders' equity. And shareholders' equity usually includes, the stock value. And it also includes the retained earnings. And the retained earnings is basically, the net income that comes in. And again, there's a few slides later, you'll see how all of this is interconnected rather beautifully. But long story short, the liabilities section includes the current liabilities, the long-term liabilities, and the shareholders' equity. And if you add all of those, they have to equal the total assets value. So over here, you can see, for example, 1,956, and the total liabilities, again, the same values right over here. For 2013, again, you see the same values on both sides. So, it's balanced out. Okay, now I'm going to dive just a little bit deeper into these sort of categories. In assets, as I mentioned, there is a current assets category, and there's a long-term assets category. Current assets are short-term in nature. They're liquid assets, and they can be converted in cash in the next accounting period. So, these are, if you go into the market, you want to sell your inventory, for example, you can sell it. The account receivable, let's say some amount of money is due from somebody, you can actually give that to somebody else and say, hey, this person is going to pay you this amount on this date. That is therefore included in current assets. So within the next period, the next accounting period. So you can say like within the next year, these assets can easily be converted into cash. So that's what falls under current assets. In long-term assets, these are goods that are harder to sell. So if you wanted to sell them next year, let's say, or in the next accounting period, it may be a little harder to do so. So those therefore fall into the long-term category. So these are the key categories of assets. Now, within liabilities, let's just talk a little bit about, the three categories within liabilities. There are the current liabilities. These are the obligations that need to be paid in the next accounting period. So, the accounts payable, you have taken a loan, you have to pay it within the next year. It's going to fall under current liability. Accrued expenses, these are expenses before it's paid. These could be wages, interest and loans, taxes. These are again, things that are payments that are coming up. You have to pay them within the next period, accounting period. So these are things that are all, expenses that are, coming up really quickly. Notes payable, short-term bank debt, all of these again, short-term debt that you've taken that you need to pay back to the bank. Now, the long-term liability is kind of easy to understand. These are long-term loans. These could be bonds or mortgages that somebody has taken. Finally, in the equity section, there is paid in capital. These are basically, sums of money that investors pay. So it could be an initial investment, and your donors or the people, your shareholders, actually paid some money to, let's say, start a company. That is paid in capital. Retained earnings, as I mentioned in the previous slide, this is basically the income that has been earned or the profits. So it is the revenues minus the expenses, and that retained earning falls under the owner's equity. The reason it falls under the owner's equity is, in many cases, especially in public companies, this retained earnings is then sort of given in various forms to shareholders. So this could be in terms of dividends, for example. That's one way of giving the money back to shareholders, but there are many other ways. So these are the three categories. Again, very important to mention that your total assets have to equal your total liabilities. So everything, current assets plus, long-term assets have to equal current liabilities plus long-term liabilities plus owner's equity. So that is very, very important as far as a balance sheet goes. And you can also see from the word balance sheet, it's the whole term is coined because there is a lot of balancing going on within the income, within the balance sheet. So each side has to balance each other out. Okay, moving on. And now I'm going to talk to you a little bit about how supply chain transactions affect both income statements and balance sheets. So for this, I'm going to take an example. The example is that a company is selling a product for 10,000 cash, and the product costs 2,000 to produce and deliver. So let's see what impact this has on the income statement and balance sheet. Well, first of all, if the company has sold a product for 10,000 in cash, that means that $10,000 worth of revenue is coming in. The cost of producing that good was 2,000, so we know that the cost of goods sold is going to increase by 2,000, and we also know that the net income is going to increase by 8,000, and that is basically 10,000 minus 2,000. So the revenues minus cost of goods sold. Now, the same transaction, let's look at the same transaction. We've now understood how it impacts the income statement, but let's look at how it will impact the balance sheet. Well, first of all, you have 10,000, in cash coming in. So because cash is a liquid asset, the current assets are going to increase by $10,000. Also, your inventory is going to go down by 2,000. because you had these 2,000 worth of product in your inventory that's in your warehouse. It's no longer there. You have now sold that. So that 2,000 is going to go down in your value of your inventory, and your retained earning, meaning the amount that you have earned in the period of, because of this transaction, is going to increase by 8,000 because net income increased by 10,000. So again, this is a really gross kind of simplification of a transaction, because there's so many other elements such as tax and interest, all of these things. But keeping that aside, this example, you can see how one transaction is impacting two of these income statement balance sheets separately. And so here, again, you can see in this, for example, this is an Amazon.com income statement and balance sheet, and you can see that the sort of the amount of net income or loss is actually shown in the retained earnings, right? And so basically, again, how everything really is balancing each other out. Okay. So if you look at this, you'd be like, hey, I do not see negative 241 anywhere over here. What's going on? So again, if you subtract, 1949 from 2190, sort of these values right over here, the retained earnings, you will see if you subtract it, it will come to negative 241. So this is how you will see. You won't necessarily see the exact net income over here, but you'll see a change in the net and the retained earnings that will equal the net income. So again, something interesting for you to note. Okay, so the role of accounting. There's several different roles. So the accounting department in any company, they have to report all the transactions of the business, and they have to classify and understand exactly what's going on, what expense, what revenue falls in which bucket. They also have to, the accounting department needs to make several reports. Usually there are financial reports. Those are reports that are sent to the investors. There's tax accounting reports that are sent to, if you're in the US, it will be, the IRS. If you're in Pakistan, it will be the Federal Board of Revenue. And there are also product costing reports. So this basically is a breakup, more detailed breakup of the costs, costing within a company, and that is given to the management. It is important to mention that in accounting, there are choices. There are different choices of how, various transactions are going to be sort of captured in income statements. But there are limits. There are limits and legal guidelines that do need to be followed. So very important to mention this. Now, moving on. I did mention this to you a little while ago, but on this side, I don't want to repeat what an annual report includes. So an annual report includes the income statements, the balance sheet, the cash flows. It includes notes to the financial report. So it includes basically, why there have been certain changes that have happened on income statement, balance sheet, cash flow. Also, there's usually a chairperson or a CEO's comments that explain the performance, and they really kind of give a little bit of insight as to what to look forward to in the company's operations in the next period. Additionally, there is usually a statement from a public accounting or auditing firm, and they offer the opinion as to whether or not the reports that the company is publishing are a fair representation of what has actually happened. And also they sort of say, okay, you know what, these have been followed. These statements have been, used the generally accepted accounting principles. And that's pretty much it. So they don't really want to give too much more than that. But the public accounting and auditing firm kind of go on to sort of vet or verify that whatever the company is saying is pretty accurate, it is correct. And so it is something that investors can sort of buy or believe. Another thing, also mentioned a little while ago was that their accountants also prepare tax and financial reports, each with a different objective. So for when they're preparing financial reports, the financial accounting objective is to present fairly the results of operations and financial conditions of the company to its stockholders. So again, financial reports are basically, the objective is, for the stockholders, it is giving a very clear picture, an indication of what exactly is going on in the company. And then there are also some tax reports that need to be made. And so these are corporate tax planning, accounting objective. The objective of these tax reports is to minimize the current tax liability and defer payment of liability as long as possible. So obviously no company wants to pay a large amount of tax. So accountants are usually hired to sort of think creatively about how to minimize the tax liability and, if possible, defer the payment of the taxes for as long as possible. Generally speaking, companies keep two sets of books. One is for financial reporting and the other is for tax reporting. And it is allowed, for example, Federal Bureau of Revenue or the IRS or any of these tax governing bodies do allow companies to deviate and have these two sets of books. And so they understand that in specific areas when calculating taxable income, there may be differences in both of these sets of books. So this is not something, this is according to the law, it is done pretty much by every company. I do want to talk to you a little bit about depreciation. I had mentioned that this is an expense that does show up on the income statement. So let me just talk to you a little bit more about depreciation. Depreciation is an expense. It is a non-cash cost to the business. And I kind of spoke to you a little bit about this, when I was giving you the whole example of the car and how the value goes down according to how many years it's been used. So just to repeat and make it a little bit more clear for you, is the estimated cost of using capital or fixed assets in a given accounting period. So if you use something, let's say there's a plant or equipment that has been used for 1 year, the value will be lower than a brand new plant or equipment of the same specifications. The capital asset on the balance sheet is reduced by the same amount as the depreciation expense in each period. So again, remember, whatever is happening on the income statement is having a simultaneous impact or effect on the balance sheet. So the depreciation expense is captured as a depreciation expense on the income statement, but what happens on the balance sheet is that the value of the, let's say, plant or equipment goes down year by year. And so after the whole life of the, let's say there was, it was when you bought a plant or equipment, let's say the value, it was expected that the particular equipment will last 5 years. After 5 years on the balance sheet, the value of that equipment will be 0 because you would have depreciated it. You would have finished it over the period of 5 years. The depreciation would have decreased the value and you would have been accounting for that in the income statement as well. So kind of an interesting way how all of this works out. And I'm going to sort of give you an actual example. So let's talk about a truck that cost $60,000. It had an estimated life of 5 years and a salvage value at the end of 5 years of $5,000. What is a salvage value? A salvage value is the amount that you think you can sell that particular truck for at the end of 5 years. So if you go after 5 years of using the truck, you go into the market, you try and sell it, you will be able to get $5,000. So how do you depreciate using a straight line method? Just a quick note over here, there are several ways of depreciating assets. One of them that I'll be discussing today is the straight line though. So how you do it is you take the value, the original value of the truck minus the salvage value. So that's 60,000 minus 5,000, which is 55,000. And you divide that by the service life of 5 years, and that gives you $11,000. So that is how you calculate the annual depreciation expense. Now, what is the impact on the taxes? Let's have a look at that. So you've calculated that your depreciation expense is 11,000. Well, the firm is able to record an additional 11,000 in expenses for each of the 5 years. So you are able to, there's no real expense that's happening, but this depreciation expense is just something that you're calculating that you are able to add in your income statement. It's not like, there's money going out necessarily, but it is an expense that you are able to sort of record in your income statement. And so this basically means that your recorded profit each year is going to go down by 11,000 for 5 years. And so because of that, you have lower taxes for 5 years. And and you are able to retain the actual cash because this is a non-cash transaction. So depreciation is a non-cash transaction. So there's no outflow of money or money going out, but at the same token, you have lower taxes because of your depreciation, which is great, right? Because again, remember, everybody wants to maximize their profit. Okay, so next up, I'm going to talk to you a little bit about accounting concepts. We're going to cover accounting concepts. And then, following that, I'm going to talk to you just a little bit about supply chain, how it impacts financial reports. And I'm going to wrap it up with a quick chat on working capital and cash flow state, the cash conversion cycle. Okay, so let's look at accounting concepts. There are basically a set of concepts that guide all accounting practices. So it's almost like a book, you can say, or a set of rules that are globally accepted. They basically have to be followed by all accountants. But within those rules, there are some choices that can be made by whoever is making the financial statements. Some of those choices are whether you want to use cash-based versus accrual-based accounting. I'll be talking a little bit about that. Aggressive or conservative recording of transaction, categorization of transaction as an expense or asset, allocation of overhead, structure and use of costing systems. So there are a bunch of choices within those set of rules that do have to be followed by every company. So these are, on this slide, there are some basic accounting concepts. These are kind of a set of rules. These are not all the rules, but these are some of them. I'm going to be talking to you about, I think, the first 4 or so. But it's important for you to know that there are these accounting concepts and that do need to be followed. So in today's lecture, I will be talking a little bit about the dual aspect concept, the accounting period concept, conservatism concept, the accrual concept, and the others you can feel free to sort of go through. You should be acquainted with these just for your information, because no matter whatever area you work in, whether it's supply chain or whether it is marketing or finance or any area, it's really important to really have a good grip of these financial statements and be very comfortable with them and really understand what are the rules under which these are being made, right? So just to sort of get you acquainted with a couple of these, accounting concepts, let's go. And as I mentioned, I'm going to talk about, the first four. Let's talk about the first one, which is dual aspect concept. And here, this is something I've been mentioning, pretty much throughout this lecture, but it is that assets always have to equal liabilities. Remember that, assets include current assets, long-term assets, and liabilities include three categories: current liabilities, long-term liabilities, and owner's equity. And so your total assets have to equal total liabilities and owner's equity. So very important for you to sort of remember this, especially from a balance sheet point of view. This is all, showing on, it's all talking about what's happening on the balance sheet. Also, as mentioned earlier, balance sheet is basically what is happening in terms of assets and liabilities at one particular moment at time. So it does not capture, it's not like what happened throughout the year, it's just at a one particular time what is going on, if you want to look at the assets and the liabilities. Okay, next basic accounting concept that I'm going to cover today is accounting period concept. And this is that the income statement is presented for a period of time, and it is not a snapshot. And typically it's a 1 year time frame. So the income statement really kind of includes all the revenues and all the expenses that were incurred over a period of 1 year. There are three basic categories within an income statement: the revenues, the cost of goods sold, and the profit. And then of course, there's a lot more with it, additional costs and all of that, which I've discussed in the lecture. But these are the three big categories. So the third one, and let's talk about that one. This is the conservatism concept, and so this basically says that accountants should adopt a more conservative choice when faced with an option. So accountants should recognize expenses and liabilities when they are reasonably possible, recognize revenues and assets when they are reasonably certain. So let's say there is a situation where you think that, something may happen. Well, better for you not to sort of recognize it until you are pretty sure. So you don't want to necessarily kind of paint a rosy picture that is inaccurate. You want to paint a very accurate um, kind of picture. And so therefore, accountants should use a conservative approach. And you should choose the recording method that results in the lowest assets or the highest liability figures. So again, always erring on the side of caution. And so, for example, if you have to choose the lower of cost or market when recording the value assets, so always, when given a choice, right, you always want to kind of go on the side of conservative, of being conservative, or being, kind of on the lower side. So for example, if there was, an asset that you have a choice of whether you want, how much it cost you versus what the price is in the market, you always kind of want to go with the lower of the two when putting it on your financial statements. So that's basically conservatism concept. Finally, I'll be talking to you about the accrual concept, and this is that income should be recognized at the time of a major event or accomplishment, not when the cash is received. So sometimes cash is given up, early. And if somebody says, you know what, I'm just kind of going to give you a deposit, but it doesn't really mean that the transaction has happened. So the deposit should not be sort of put on the income statement or the balance sheet, and so on and so forth. You only recognize a transaction once it has actually been done. And once it has been done, then you basically, recognize it and sort of on your financial statements. Companies choose between accrual or cash basis, but mainly only small private firms use cash basis. So it can be used, the cash, using, like, for example, if there's a startup and somebody, has just started a business, For them, they may use a cash basis. Just because they are working on a very small scale, even one transaction means a lot to them. Um, so they may use that, but generally speaking, for larger or mid-sized companies, the accrual method is used for accounting, and this is when recognize a transaction when it is actually accomplished or if a specific event happens. Um, so, yep, there's an example on the slide which I'll take you through. Assume a company requires payment in advance for a custom furniture order worth 2,500 and ships the furniture on June 15th. Now, so again, there's a company, it requires a payment in advance. Somebody has said, okay, pay us in advance for a transaction. So 2,500 paid us on April 1st. And then after that, we will start making your furniture. So when should the 2,500 be recognized on the income statement and the balance sheet? Well, if you're using the accruals method, then you would recognize the sale on June 15th when the furniture is actually made and shipped out. That's when the transaction actually kind of happens. But if you're using the cash method, then you recognize the 2,500 on April 1st. So again, usually better to use the accrual concept. So we saw, like for example, the accrual or cash, these are, kind of the kind of choices that companies have. There are a lot of other choices accounting choices that companies have, such as, how do they want to allocate their overhead? There are many methods of allocating overhead expenses, and overhead expenses are like, administrative big expenses like electricity, administrative expenses, right? Rent, electricity, all of those. How do you want to sort of allocate those? Shipping, warehouse, all of those things. How you want to categorize your expenses. I mean, there are some rather large buckets. We've sort of discussed how those big buckets work, but the nitty gritties of how you want to categorize expenses, there are choices in how that can be done. Depreciation methods, there are different rates. We use the straight line method in this lecture I showed you, but you can use accelerated depreciation methods as well. That's up to the company, it's their choice. Also, whether you want to use an asset or expense method, you have bought, let's say, a capital good. Do you want to sort of recognize it, on your balance sheet using as an asset or as an expense? This is your choice. All right. So these are some of the choices that are given, accounting choices that are given to companies. Another really interesting thing is a choice that is given to companies is how they want to value their inventory. In order to keep track of inventory, you do need to measure it. And so it is measured usually in terms of money. There are many ways of really, and these are all generally accepted methods of identifying what is the value of the inventory. One method is, and most of you must have heard of these by now, the simple average, weighted average, moving average. There's also the last in, first out, or the LIFO, and the first in, first out, or the FIFO. Generally speaking, last in, first out is used for financial reporting. And I'm not going to go in too much detail in inventory valuation. This is something that you can definitely look a little bit more into detail yourself. But it is important to sort of mention that, how the value of inventory can be calculated in many, several ways. For any supply chain transaction that happens, it usually impacts both the income statement and the balance sheet. Also, it's important to consider financial, tax, and managerial accounting, core accounting principles, and inventory valuation. all of these things have an impact. All these choices that companies make and how they want to build up their financial statements do have an impact on the net profitability that is shown of a company. And also, it is important to mention that, oops, just one second, that every transaction that happens, every supply chain transaction that happens does impact both the balance sheet and the income statement. Just a little while ago, I gave you the whole example of the sale of, uh, a printer system, for example, for 10,000, the cost of production was 2,000, and I kind of explained how it impacts the income statement and the balance sheet separately. I also wanted to show you this particular slide, which is a visual way of kind of seeing what is happening. So, what's happening on the income statement, and what is happening on the balance sheet. And I explained all of this to you. The revenue is increasing. Simultaneously, the cash is increasing because it was sold for cash. The cost of goods sold is increasing. This was the expense associated with the sale of the goods, but so is on the other side, the value of the inventories is decreasing on the balance sheet. So net, you do see that there is a profit of 8,000. You see the total assets increased by 8,000. On the other side, on the income statement, you kind of see that the profit over here, this is impacts the total liabilities and owner equity positively by 8,000. And so the assets equal the liabilities. And so those balance out. There's a net a difference of 8,000, both on the asset side, the liability side, and the net income goes up by 8,000 as well. So here you can see, how one transaction is impacting, both of these financial statements. And it's quite fascinating how all of these sort of work simultaneously. So again, very important for you to be very comfortable with understanding that. Here, I kind of just wanted to also, on this slide, talk to you about how supply chain management affects various financial reports. And it's sort of linked, you see there are certain metrics that are used to understand the supply chain impact, such as the order cycle time. And here on this slide, I'm not going to go into much detail, but you can see how every single supply chain metric, everything that's happening in the supply chain has impacts on the financial reports, whether it's the order cycle time, the on-time orders, as ordered orders, the fill rates, accurate billing, inventory turns, all of this has is linked to the financial reports and actually is calculated using the financial reports. So very important for sort of relationship you can see between supply chain management and accounting and what's happening on these critical financial statements. Finally, towards the end of this lecture, I am going to talk to you a little bit about working capital and the cash conversion cycle. So first, let's talk a little bit about what working capital is. Working capital is basically current assets minus current liabilities. Again, we kind of discussed this a little while earlier. Current assets is basically everything that you're expecting for you to be able to materialize or get in your pocket within the next accounting period. Current liabilities is basically everything that you kind of need to pay out in the next accounting period. So one thing that companies really kind of keep a keen eye on is the working capital requirements. And so what happens is many times companies go out of operations not because they're running into losses. They may be very profitable. Everything, their balance sheet may be looking good, but cash flow problems. This is perhaps one of the most common reasons that companies go out of business. So companies really try to keep an eye on what is going out. So they run out of cash. If any company runs out of cash, they're in big trouble. So companies usually calculate their working capital requirement using a formula, which is account receivable plus inventory minus account payable. And again, they want to basically have so basically, if you look at this working capital requirement, this formula, the lower the value, the better it is for a company. It is, generally speaking, the way to make this low is to collect payments as quickly as possible from your customers, keep your stock levels as low as possible, and delay paying your suppliers as long as possible. So these are three basic things that companies really try to focus on in order to keep their cash flows positive. And very important to really know this. This formula right over here, account receivable plus inventory minus account payable, this is, to a large extent also known as the cash conversion cycle. The cash conversion cycle is a liquidity measure that can help company plan its timing of working capital requirements. This measure, it is usually done in number of days. So, I'll talk to you a little bit about this in the next slide so that you get a better understanding. The shorter the cycle, the more liquid a company is, and the better the working capital position is. So as I mentioned to you, the lower the value of this particular formula, the better it is for a company. If it's high, the company is running into serious cash flow problems. How is this calculated if we want to really go a little bit more in detail? Well, first, it has three different parts. You have to calculate the days of inventory outstanding. This is the average inventory in the system expressed in the number of days. The formula for this is the average inventory divided by cost of sales multiplied by 365, which is the number of days in a year. You also need to calculate the days of sales outstanding. This is the average number of days to collect revenues from sales. The formula for this is average account receivable divided by total sales multiplied by 365. Finally, you need to calculate the days of payable outstanding. This is the average number of days before paying the supplier. This is average accounts payable divided by cost of sales multiplied by 365. The cash to cash cycle, or the cash conversion cycle, is, DIO, days of inventory outstanding, plus DSO, days of sales outstanding, minus days of payable outstanding, or DPO. Again, very important for you to remember, the larger the cash conversion cycle, the worse the company's liquidity position is. If the cash conversion cycle is negative, it means that's great. That's an ideal situation. That means that the company has extra cash to invest and it's got an excellent liquidity position. So with that, I come to an end of this lecture. I hope you enjoyed it. I hope you learned a little bit about financial statements and you are feeling a lot more comfortable and you're getting some sort of a more understanding about how supply chain transactions impact the key financial statements. With that, I come to an end to today's lecture. I hope you enjoyed it. Take good care of yourself and stay safe. Thank you very much.